Hey everyone, and welcome back to the channel. In today's video, as you can see, we're doing stock market Q&A for the month of November. We're almost at the end of the year, and I've done pretty well to make one of these videos every single month. I think I missed 1 month, maybe July or August or something, but we're almost at the end of the year and we've done one every single month. And as of course, we're going to be doing one next month. So if you have a question for next week and I didn't get to answer yours in this video, then go ahead and leave it as a comment below this video, or then you need to make sure to look out for the community board post that I'm going to be making a couple of weeks before I make that video. So if you're new around here and you're not aware, make sure you hit subscribe, because every month, a couple of weeks before I make the Q&A video, I make a post on the community board that will appear in your subscription box if you're subscribed. And on that post is where I grab most of the questions for this video. So make sure you're subscribed so you can ask a question, see that post and ask a question for next month's video. But without further ado, let's get straight into this video and start answering some of your questions. So the first question that we had here is, hi Hamish, how often do you value an enterprise on your watch list? Do you run calculations, say, every quarter? Does the intrinsic value change significantly over shorter periods of time, say 6 months? And that's a really, really good question. I guess I'm kind of in a constant state of evaluating businesses that I have already previously analyzed. And what I mean by that is, once you've done the bulk of your analysis, it will just be an ongoing process of keeping up with the news and what is happening within the business over time. With that being said, the actual value of the business and the conclusion that you draw from an analysis will not change much over a quarter or over 6 months or even a year in many circumstances. There are circumstances where businesses will have something substantial that happens for them. Maybe they take on an acquisition and they're going to be taking a lot of debt as a result of that, and that might change dramatically your opinion about that business and its debt management and that sort of thing. But for the most part, businesses don't change that much over shorter periods of time. What you're more likely going to see happen in shorter periods of time is short-term news that affects the stock price, but not your overall analysis of the long-term success of that business, if that makes sense. In terms of running the intrinsic value calculations, like doing a discounted cash flow, entering in and calculating cash flow for owners and putting that in and estimating some growth rates into the future, that kind of calculation is something I generally do once per year. So when the annual report comes out, we get the new operating cash flow numbers, we get the new capital expenditure numbers, we can come up with the latest cash flow for owners, we can then put in the numbers into the spreadsheet and get the latest growth numbers, and maybe we might have some changed opinions about the growth of the company in the future, but more likely I won't be changing the growth prospects of the company and that sort of thing. And then I might do some recalculations to see if intrinsic value changes. But over 6 months, over a year, intrinsic value really doesn't change that much for the most part. The next question that we've got here is, what is company equity and why does equity growth predict overall growth? So the equity itself is essentially assets minus liabilities. So if you take the assets of a company and you subtract the liabilities, what you're left with is equity. But a better way to think about it when we're coming at this with an investing mindset is that rather than thinking of it as assets minus liabilities equals equity, you should think of it as liabilities plus equity equals assets. And the reason why you should think about it that way is because it's liabilities plus equity, which are the two places where money comes from that the company has bought assets with. So either the company has taken on some debt, some liabilities, and bought some assets, or they've gotten the money from equity. And equity really comes from two places. One, raising capital, selling shares on the market, most commonly when there is an IPO, or from reinvested earnings, from earnings generated by the business. So a business itself is funded through debt, through liabilities, through debt, liabilities, or through reinvested earnings, which is equity essentially, or it's a part of equity. So that's how you should think about it when you're thinking about equity. It's one of the two ways in which assets are funded. And really what equity means is it's the proportion of the assets of the business that are owned by the shareholders. So if you take the assets and you subtract all of the debts that the company owes, what's left over is equity, the proportion of the business that is reinvested earnings. It's what's owned by the owners. It's what's left over after all of the normal operations of the business have been paid for and debt obligations have been paid down. And the reason why this is the best predictor of long-term stock growth and the value of the business going up is really as simply as because it is the proportion of the business that is attributable to shareholders. If a business has $100 in cash and it has $50 in debt, then the equity is $50. And that means that if you buy that company, you're essentially buying into $100 in cash and $50 in debt. So you could imagine that, like, you buy the whole company, you get a $100 bill, and you get $50 in debt that you need to pay. You can use half of the $100 bill to pay the debt down, and what you're left over with is $50. So that is actually what you get when it comes to the business as an owner. So over the long term, if equity is going up, it's very likely that the stock price is going to go up with that. Really, the two drivers of the value of a business are equity and how much cash flow it can produce. And really, the relationship between those two is what we call the return on invested capital. It's how much cash flow can a business generate from the investments that the business has. So it's really a combination of both of those things. And generally speaking, instead of using equity growth as a predictor of the stock price growth, I much prefer to use cash flow growth as a predictor of future cash flow growth. Because remember, stock price is only one of the two ways that we get a return out of a business. So equity going up and the stock price going up, that's one way, but we also receive dividends. And the way that we can look at both of those is by looking at cash flow for owners, which is essentially the amount of cash that is left over after the business operations in order to be either used to reinvest and grow equity or to pay out directly as shareholders. But I put a video out a couple of weeks ago, I think, talking about that. So if you're interested, I'll leave a link to it down in the description below. The next question here is, I'm a newbie and would love to know how you would shorten the list of stocks in a screener that are worth doing a full evaluation on, especially at times of a recession. Yeah, so how do we shortlist some businesses that we're going to then go ahead and do further analysis into? And there's really two ways that I like to do this. The first way doesn't even use a screener. What I do is I just pick an industry that I understand. We all have industries that we're interested in or industries that we have a basic understanding of. Maybe we're a customer in that industry or we've worked in that industry in the past for a number of years. Find that industry and pull up a list by Google searching and pull up a list of all of the publicly traded businesses in that industry, whether that's on the US market or the Australian market. And then just go one by one through them and eliminate the ones that don't meet our basic requirements. And you can do this with a stock screener as well. And what I mean by basic requirements, my first few requirements really are, debt, has low levels of debt. We need to have it needs to be a business that's been on the stock market for at least 10 years. It needs to have 10 years of financial data. Sales, earnings per share, equity, free cash flow, they need to be growing fairly consistently over time. And once we've looked at those really core things, we will have eliminated 99% of businesses and we'll be left with maybe one or two or three businesses in each industry that we can then dive further into and figure out which one is the best, which one's the best business and which ones are the best of value at the moment, depending on where we are in the particular industry. The next question we've got here is, what psychological mistakes are you most prone to making and how to avoid them? That's a good question. There's a lot of psychological mistakes that you could make as an investor. One of the more common ones would be confirmation bias. So that's really essentially having an idea about a particular business, thinking it's great, and then essentially what that means is you're more likely going to seek out information that supports your opinion rather than objectively looking at all of the information. And I guess the best way that you can overcome this is to actively seek out information that goes against your opinion, your hypothesis. So if you think a company is going to do very well in the future, actively seek out opinion articles and that sort of thing from people who believe the company is not, and see what the opposing arguments are and weigh those up. In terms of other psychological barriers, I guess another major one would be people who get fearful when a stock price is going down. When the stock price moves in the short term of a business that you've purchased or not, the stock price movements in the short term have nothing to do with your investment decision, and they often have nothing to do with whether the company is going to be successful over the long term. And that's a hard thing to wrap your head around. When you buy an investment and it goes down 20% over the next 3 months, you feel like you've done something wrong. But what you need to do is you need to have the discipline to realize that anything that happens in the short term is completely irrelevant. If the stock goes up, you're not a genius. If it goes down, you're not an idiot. You need to be able to separate yourself from the market and just analyze the business and make sure you understand the business, because in many cases, the stock price movements in the short term will not be representative of what the business is going to do over the long term. And you need to be able to separate those two things without getting caught up in both of them. A lot of people, I see this all the time and it makes me cringe. People making stock market decisions in the market, seeing the stock go up for 6 months, and they think that they've made a right decision. And they might very well have made the right decision, but the stock price going up for the next 6 months is not an indication of that. Those two things might be correlated, they might be separate. So just keeping your head out of the market and more on the side of analyzing the core underlying businesses, because in the short term, anything can happen, but over the long term, the great businesses that produce a lot of cash for their shareholders will see their stock prices go up substantially. The next question we've got here is, can you sum up all of the mistakes and how much it cost you? Also, please tell us if you do short-term trading on the side. To answer that second part first, I do no short-term trading whatsoever. I have no interest in gambling in the short term, and I think a lot of you would be much better off if you avoided trying to gamble in the short term, because I mean, a lot of people kind of say, well, I have my long-term portfolio, but then I get bored, so I need to do something in the short term. Well, start a business or do something else. Do something where what your actions are going to do has, a high chance of being correlated with success. When it comes to short-term trading, anything can happen. It's just gambling. It's like I don't know, it's like going to the casino. That's really what it is. And I just think that's silly. I think if you're bored about investing, then start an investing related hobby. Do what I do, make YouTube videos, talk about investing, share your experiences with investing. Even if you don't know a lot, you can just create videos and share your journey. You don't need to teach people. You don't need to act as some kind of expert. You could just share your experiences, whether that's on Instagram or YouTube or on a blog or anything like that. So I think that if you're bored in the short term, find something else finance related that you can do with your time, rather than getting caught up into the short-term trading and the gambling of the stock market, which may end up ultimately costing you a lot of money. And it hurts your discipline, because on one side you have this long-term portfolio, but then you're kind of feeding the part of your mind that wants to be a gambler. I just don't want to feed that part of my mind at all. I want to be completely rational when it comes to investing. And as for the first part, sum up all of your mistakes. I mean, it's hard. It's hard to do that, because I made some of my very early investments that I would call mistakes because I didn't thoroughly analyze those businesses. A lot of them turned out to be quite successful. I mean, one of the first businesses I invested in was called Vocus Group. It's a telecommunications company in Australia. And I didn't understand the business. I didn't analyze it properly. It was back in 2017, I think, early 2017 when I invested in this company. And the stock went up 50% in 3 months. So while I would categorize it as a mistake, it didn't cost me anything. If that kind of makes sense. And that was kind of my experience for a few of the businesses that I got into quite early. In terms of unrealized gains, stocks that I still hold, the biggest position that I'm down on, I would not consider a mistake. That would be Thor Industries. And I mean, when I first started investing in Thor Industries, some of those shares that I bought a few shares to dip my toes in very early on in that stock. They might be down 60 or so percent. But for the most part, the stock that I've bought in the business, I think more than half or maybe more than 3/4, I think, of the stock that I've bought for Thor Industries have been purchased at a price that is down less than 10%. So while the stock's fallen quite a lot, I've done a lot of heavy buying down towards the bottom, and that's kind of helped me out. I guess maybe it would have been a mistake. I guess you could argue that it was a mistake to start investing when it was higher, but that's kind of how I've always operated. I dip my toes into something, and that way when I have some skin in the game, I'm willing to go to the extra efforts that are required to learn everything about that business. And I've been learning about Thor Industries over the past 2 or so years, and that really started with me dipping my toes in. And then over time, I developed a better understanding of what the true intrinsic value would be, and as a result was able to make smarter investments at a lower price. But yeah, I guess that kind of answers that question. And then the final question that we have time for today is, I know that you talk about the importance of the return on invested capital all the time, but do you just look at the return on invested capital, or do you subtract WACC from return on invested capital to get a more accurate spread? Yes, that's a good question. So return on invested capital is a measure that I use as an indication of how effective management is being at investing within the business. But just looking at the number itself, we need to compare it to something. We need to say, is that high enough for us? And for me personally, I like to see a return on invested capital that's between 10 and 15% consistently. 15% or more is really what we're looking for. And you might wonder, why 10 or 15%? Why not 30%? Why not 4%? And the reason why is that I'm trying to invest in companies that can compound their earnings at 10 to 15%, right? And if management is generating an internal return of 10 to 15%, then by reinvesting all of their earnings within the business, they're going to be able to compound their earnings, their cash flows at 10 to 15%. So that's why we try and look at that range, because companies that are generating 10 to 15% and reinvesting within the business are going to be compounding their earnings at a similar rate. The way that you should think about it is that if a company is earning a return on invested capital of 10%, but they're only reinvesting 50% of their earnings, then they're going to be growing their cash flows at 50% of the return on invested capital, which would be, in this case, 5%. So really, when it comes to the return on invested capital, we're looking for a few things. We're looking for it to be above 10 to 15%. We're looking for consistency over time. But not only that, we also want to be investing in businesses that are consistently reinvesting as much money as possible. They're compounding their earnings and their cash flows within the business. So that's all we had time for today, guys. I hope you enjoyed this one. And as I said at the start of the video, if you do have any questions that you want to be answered in the next video, then you can do one of two things. The first thing you can do is you can leave it as a comment down below this video. The second thing you should do is hit subscribe so that you can see the community board post that I'll be making in about 3 or 4 weeks time. And when that post is made, you can also leave your comment there, and that is the place where I get most of the questions for these videos from. So I hope you guys enjoyed this one, and if you did, of course, hit subscribe, leave a like, leave a comment. Anything that you can do to help out is awesome. Completely lost my train of thought there, but thanks everyone for watching, and I'll see you guys in the next video.